Everyone is watching gold right now, but almost nobody is asking the most important question. Are we witnessing the beginning of the biggest gold bull market in modern history, or are investors getting carried away by another wave of optimism? One of the world's best-known macro strategists, Jim Rickards, believes the answer is already hidden in history. According to him, the current gold rally is not the end of the story. It may only be the beginning. But before anyone starts believing eye-catching price targets, we need to separate historical facts from bold predictions. Because in today's financial markets, understanding the difference between evidence and speculation can be worth thousands of dollars. Welcome to Macro Bullion, where we analyze gold, silver, and the global economy through the lens of macroeconomics instead of market hype. On this channel, our focus is simple. We study central bank policies, inflation, interest rates, currency movements, sovereign debt, geopolitical developments, and long-term historical trends to understand where precious metals could be heading next. Every opinion shared here is supported by publicly available economic data whenever possible, while future price projections remain opinions rather than guarantees. To understand Jim Rickards' latest outlook, we first need to go back to one of the biggest turning points in modern financial history. In 1971, the United States officially ended the Bretton Woods monetary system, removing the US dollar's direct convertibility into gold. Before that decision, gold functioned primarily as money with a fixed relationship to the dollar, meaning investors could not experience the kind of large price swings that define today's market. Once the dollar was no longer backed by gold, the precious metal began trading freely according to supply, demand, inflation expectations, monetary policy, and investor confidence. That single event transformed gold from a fixed monetary asset into one of the world's most important financial safe havens. Jim Rickards argues that since 1971, gold has moved through several major long-term cycles. The first great bull market stretched from the early 1970s until 1980. During that period, gold climbed from roughly $35 per ounce to nearly $850. Depending on the exact starting point used, that represented gains of well over 2,000%. The economic backdrop was dramatic. Inflation reached extremely high levels, oil prices surged, geopolitical tensions increased, and confidence in paper currencies weakened. Investors searched for assets capable of preserving purchasing power, and gold became one of the biggest beneficiaries. Every bull market, however, eventually reaches a point where optimism becomes excessive. After peaking around 1980, gold entered a prolonged bear market that lasted nearly 2 decades. Prices gradually declined from around $850 to nearly $250 by 1999. Many investors concluded that gold had lost its importance forever. Capital flowed into equities as technology companies dominated financial headlines, while precious metals became one of the least popular investment sectors in global markets. History proved that assumption wrong. The second major bull market began quietly in 1999 when gold reached its long-term bottom near $250 per ounce. Over the following 12 years, prices climbed steadily until they reached approximately $1,920 during 2011. That represented gains exceeding 600%. This rally was supported by several major economic events, including the dot-com crash, the global financial crisis of 2008, aggressive monetary stimulus from central banks, historically low interest rates, and growing concerns about government debt. Once again, investors turned toward gold as confidence in traditional financial assets weakened. Rickards believes that every major commodity bull market follows a similar rhythm. Instead of rising in a straight line forever, prices usually experience a deep correction before beginning another powerful advance. To explain this idea, he often refers to a conversation with legendary commodities investor Jim Rogers. According to Rickards, Rogers explained that long-term commodity markets frequently experience corrections of around 50% before continuing their upward trend. Rather than viewing those declines as the end of the cycle, Rogers saw them as the foundation for the next phase of growth. Rickards applied this framework directly to gold. After climbing from approximately $250 in 1999 to nearly $1,900 in 2011, gold entered another painful correction. By December 2015, prices had fallen to around $1,050 per ounce. For many investors, that decline confirmed the end of the bull market, but Rickards reached the opposite conclusion. Based on the historical retracement pattern discussed with Jim Rogers, he believed the correction had already completed its purpose. In his view, December 2015 marked the beginning of an entirely new long-term bull market rather than the continuation of a bear market. It is important to make one distinction here. The historical price movements themselves are verified facts. Gold did rise dramatically between 1971 and 1980. It did experience a long bear market into 1999. It also climbed from roughly $250 to around $1,920 between 1999 and 2011 before falling close to $1,050 during 2015. These price movements are supported by decades of market data. However, the interpretation that every future cycle must repeat the same historical percentages is an analytical opinion rather than a proven rule. Markets evolve, economic conditions change, and investor behavior adapts over time. Nevertheless, Rickards believed the evidence strongly favored another major advance. From the 2015 low, gold gradually recovered and eventually reached new record highs during the following years. This recovery was driven by several powerful macroeconomic developments. The global pandemic triggered extraordinary fiscal spending and monetary stimulus. Central banks expanded their balance sheets, governments accumulated record levels of debt, inflation accelerated, and investors once again questioned the long-term purchasing power of fiat currencies. Gold regained its role as a defensive asset during periods of economic uncertainty. As we move through 2026, the macroeconomic environment remains highly complex. Inflation has moderated compared with its post-pandemic peaks, but it has not disappeared completely. Government debt continues to expand across many advanced economies. Geopolitical tensions remain elevated in multiple regions of the world. Financial markets continue to debate the future direction of Federal Reserve policy, while central banks in many countries have maintained strong interest in increasing their gold reserves as part of their long-term diversification strategies. These developments continue to provide structural support for precious metals, even though short-term volatility remains a normal part of every bull market. These macroeconomic developments bring us to the most debated part of Jim Rickards' analysis, his long-term price target. In earlier interviews, Rickards argued that if the current bull market followed historical patterns similar to previous cycles, gold could eventually reach $15,000 per ounce. That single number captured headlines around the world. Some investors immediately accepted it as inevitable, while others dismissed it as unrealistic. But before we judge the prediction itself, we need to understand the reasoning behind it. Rickards was not simply picking a random number. His methodology was based on comparing the duration and percentage gains of the previous two major gold bull markets. The first bull market delivered gains of well over 2,000%, while the second produced gains exceeding 600%. By averaging those historical performances and applying them to the bull market that began after the December 2015 low, Rickards concluded that gold still had enormous upside potential over the long term. However, there is an important lesson that every investor should remember. History can be a guide, but it is never a guarantee. Financial markets are influenced by countless variables that constantly change. The world of 2026 is dramatically different from the world of 1980 or even 2011. Today's markets include algorithmic trading, exchange-traded funds, artificial intelligence, digital assets, higher levels of government debt, geopolitical fragmentation, and faster capital flows than ever before. These factors create opportunities, but they also make historical comparisons less predictable. There is another fact that deserves equal attention. Rickards' earlier timeline suggested that gold could approach $15,000 by 2025. That specific forecast did not materialize. Gold has certainly performed well during this cycle and has reached multiple record highs, but it has not reached that price level. This is not an opinion, it is a verified outcome based on market prices. Even highly respected macro strategists cannot predict the exact timing of financial markets. But does missing the timeline automatically invalidate the broader investment thesis? Not necessarily. One of the biggest mistakes investors make is confusing timing with direction. An analyst may correctly identify a long-term trend while being early by several years. Financial history contains many examples where investors correctly anticipated inflation, currency weakness, or rising commodity prices, yet underestimated how long those trends would take to fully develop. Markets move according to liquidity, investor psychology, monetary policy, and unexpected global events, not according to calendars. When we examine today's economic environment, several long-term bullish factors continue to exist. Global sovereign debt remains near record levels. Governments continue to face rising interest expenses. Many central banks are still diversifying their reserves by purchasing physical gold. Geopolitical uncertainty continues to affect financial markets. Investors remain concerned about the long-term stability of fiat currencies. These conditions have historically supported demand for safe haven assets. At the same time, investors must also acknowledge the risks. If inflation continues to decline faster than expected, if economic growth remains resilient, if real interest rates stay elevated for a prolonged period, or if the US dollar strengthens significantly, gold could experience periods of consolidation or meaningful corrections. Bull markets are rarely straight lines. Even the strongest long-term trends include sharp pullbacks that test investor confidence. This is why professional investors never rely on a single indicator. Instead, they build a complete macroeconomic picture. They monitor inflation reports, employment data, GDP growth, Federal Reserve policy statements, Treasury yields, the US dollar index, ETF inflows, central bank purchases, physical demand from Asia, mining supply, and geopolitical developments. Every one of these variables provides another piece of the puzzle. Another reason gold continues to attract attention is the behavior of central banks themselves. Over the last several years, central banks have become some of the largest net buyers of physical gold. This is significant because central banks do not typically trade based on short-term price movements. Their objective is to protect national reserves over decades rather than months. Their continued demand suggests that gold remains an important strategic asset within the global monetary system. Silver deserves equal attention because it often follows gold during precious metals bull markets, but with greater volatility. Unlike gold, silver is both a monetary metal and an industrial metal. It plays a critical role in solar panels, electric vehicles, advanced electronics, semiconductor manufacturing, and other high-technology industries. If industrial demand remains strong while investment demand also increases, silver has historically demonstrated the ability to outperform gold during certain phases of the cycle. The downside, however, is that silver corrections are often much deeper and more volatile than those experienced by gold. From my independent perspective, I believe investors should focus less on predicting one exact price target and more on understanding the macro forces driving the market. Whether gold reaches $5,000, $8,000, or eventually much higher will depend on future monetary policy, debt expansion, inflation trends, currency confidence, and geopolitical developments. Those factors will determine the speed and magnitude of any future rally, not a single historical formula. This is why successful investing is built on probabilities rather than certainty. No analyst, regardless of experience, can guarantee future prices. What we can do is analyze the available evidence, identify long-term trends, assess risk, and adjust our outlook as new economic data becomes available. That disciplined approach is far more valuable than chasing sensational headlines or emotionally reacting to daily price swings. As we move closer to the conclusion, one final question remains. What should long-term gold and silver investors actually do in this environment? Should they be buying aggressively, waiting for corrections, or preparing for a completely different market cycle? The answer lies in understanding the difference between speculation and disciplined investing, and that's exactly what we'll explore next. When we step back and look at the bigger picture, one thing becomes increasingly clear. Gold is not simply another commodity that rises and falls based on supply and demand alone. It is a global monetary asset that reflects confidence in governments, central banks, paper currencies, and the overall financial system. Every major move in gold tells us something about the health of the global economy. That is why professional investors pay attention to gold even if they never intend to own a single ounce. One of the biggest mistakes made by retail investors is allowing emotions to control investment decisions. When gold is making new highs, fear of missing out encourages people to buy at any price. Then, when the market experiences a healthy correction, the same investors panic and sell at the worst possible moment. History has shown this behavior repeatedly across every financial market, whether it is stocks, commodities, cryptocurrencies, or real estate. The investors who consistently perform better usually follow a completely different approach. They focus on long-term fundamentals instead of daily headlines. They understand that every bull market experiences corrections, profit-taking, and periods where prices move sideways before continuing higher. These temporary declines do not necessarily mean the long-term trend has ended. In many cases, they simply allow the market to reset before the next advance. This is exactly why Jim Rickards has repeatedly emphasized patience. Whether you agree with his price targets or not, his central message has always been that investors should think in years rather than weeks. Short-term volatility is impossible to predict consistently, but long-term macroeconomic trends often develop over many years. Investors who understand these larger economic cycles are usually better prepared than those who react to every news headline. Looking at today's macro environment, there are still several reasons why precious metals remain relevant. Government debt across developed economies continues to rise. Interest payments on that debt are becoming a larger burden for national budgets. Many central banks continue purchasing physical gold to diversify their reserves. Geopolitical tensions remain elevated in several regions of the world. Questions surrounding global trade, supply chains, and economic growth have not disappeared. All of these factors create an environment where safe haven assets continue to attract attention. However, balance is equally important. Investors should also recognize the risks that could temporarily slow gold's momentum. A stronger US dollar, higher real interest rates, faster economic growth, easing geopolitical tensions, or sustained disinflation could reduce investor demand for gold over shorter periods. Markets constantly price in new information, which is why no trend moves in a perfectly straight line. Silver deserves its own discussion because it offers both opportunity and risk. Historically, silver has often outperformed gold during the strongest phases of precious metals bull markets. This happens because silver benefits from two powerful sources of demand. First, it acts as a monetary metal alongside gold. Second, it is an essential industrial metal used in solar panels, artificial intelligence infrastructure, advanced electronics, electric vehicles, medical equipment, and semiconductor manufacturing. If global industrial production remains healthy while investment demand increases, silver could continue attracting significant interest. But investors should remember that silver's higher upside potential usually comes with greater volatility and deeper corrections. So where does this leave us? My independent assessment is that the long-term case for gold remains constructive, but it should be viewed through the lens of probabilities rather than certainty. The structural drivers supporting gold, central bank accumulation, elevated sovereign debt, geopolitical uncertainty, and long-term concerns about currency purchasing power have not disappeared. At the same time, investors should avoid becoming emotionally attached to any single price target, whether it comes from Jim Rickards or any other well-known analyst. Markets have a habit of surprising both optimists and pessimists. Instead of asking, will gold definitely reach a specific number? A better question is, are the macroeconomic conditions becoming more supportive or less supportive for precious metals? That question encourages disciplined analysis instead of emotional speculation. As independent analysts, our responsibility is not to predict the future with absolute certainty. Our responsibility is to interpret the available data honestly, distinguish verified facts from personal opinions, and remain flexible as new information emerges. That approach helps investors make informed decisions rather than impulsive ones. If you found this analysis valuable, don't forget to subscribe to Macro Bullion and turn on notifications so you never miss our latest updates on gold, silver, inflation, Federal Reserve policy, central bank buying, and the global economy. I'd also like to hear your opinion in the comments. Where do you see gold and silver by the end of 2026? Do you believe the current bull market still has years to run, or do you think we're approaching a major turning point? Remember, this video is for educational and informational purposes only. The historical market data discussed here is based on publicly available records, while future price forecasts, including those from Jim Rickards, are opinions, not guarantees. Financial markets involve risk, and every investor's situation is different. Always verify information from multiple trusted sources, understand your own risk tolerance, consult a qualified financial advisor if needed, and most importantly, DYOR, do your own research before making any investment decision.